Residential property in New Zealand seems more politicized than ever, and mom and dad investors often find themselves demonized providing a long-term accommodation service to those who can't afford their own home. What about the next property boom? Will we see a changing of the guard with newer buyers providing the exit liquidity for the old hands so they can park their capital elsewhere? If so, I wouldn't be surprised if one of those places could be commercial property. So if you're wondering if that's for you, you may also be wondering, how does it actually work? Cap rates, sale and lease backs, triple net lease terms, it goes on and on and on. From nail and hammer to pen and paper, it is still property, but not as we know it. Today, I'm catching up with Jack Revill and Carl Burling, the founders behind Provincia Property, one of this podcast's own show partners. Now, they started back in 2017 with a single industrial building. Now they're on to fund number 2. So I hope you enjoyed this episode. If you want to learn more about Provincia, check out the link in the show notes. Be sure to like and subscribe. Let's get started. Okay, so last time we had a podcast episode, we talked specifically around the pros and cons between residential property versus commercial property. This time we're going to dig in more around how the unlisted property funds work that you operate and how the private client services work. So we're going to cover things like triple net, sale, leaseback, due diligence, what makes commercial property a good option. And hopefully at the end of this, it'll be a really clear, obvious choice that if people do want to get into commercial property, that they kind of know a little bit more. So Jack, let's just go back in time, November 2017, and obviously it started with one property, this fund. So tell me about that first property, and let's just go from there.
Yeah, so that first property back in November 2017 that started Fund 1 off for Provincia was a property we found at 38 Richard Pearce near the airport, so in the Airport Oaks. It's a really good region.
In Auckland,
so,
yeah.
In Auckland. So it was a really strong location and strong low vacancy area, which is one of the key aspects we look at. So this property, it was such a good opportunity for the first fund because what we found is it had really good underlying attributes to the property, but they had short-term leases on the property, was massively under-rented, and they had an issue with the CCC. So for us, that's huge opportunity, multiple levels of opportunity to sort that property out. So it was a really good first property for the fund.
So the property had been inherited by a brother and sister, and they basically did some building works with no consents, and nothing was signed off. So the property had sat there on the market for I don't know how long, Jack.
Oh, it would have been a while.
And so it was one of those opportunities because we drive past it and we see all these real estate signs just falling on the ground, and we thought, this is quite a good location. What's wrong with it?
Yeah.
So we made the inquiry, and Jack went in and made an offer.
Yeah, and the rest is history. It was unloved, but you saw the orphan child, and you show it some love, and it loved you back as well.
Very much so.
So I want to maybe, Carl, you could speak to this one around the relationship between the rent that you receive and the valuation. We talked about that a little bit last time we caught up, how if you manipulate the rent, you can increase the valuation. But that was back in 2017, and the market has, well, it's probably come back a little bit lately, but the market went up after that quite significantly. So how much value did you guys add with the work that you did versus the natural market appreciation? How much could you actually take responsibility for?
Commercial is quite different to residential in terms of if you increase the rent in residential, you don't get a huge value increase. So it's not valued on a capitalisation rate. It's just valued based on sales and the quality of the property and where it is. With commercial property, the good thing is you can add value by increasing the rent, and you can do that two ways. You can wait for the market, or you can buy at the start of the property cycle, and then the rent's going to naturally increase. And the other thing you can do is you can buy something that's under-rented or has a problem, or there's potential to rentalise other areas. So you can add value purely by writing a new lease. With residential, you're adding value by building stuff. So you're going in there with a hammer and saw and paintbrushes and things like that. But with commercial, you can add value purely by the strike of a pen on a lease, changing the rent.
Negotiation.
Yeah. So with the increase in rent, that adds value because another investor will come along and go, well, that's got a higher rent, so I'm going to pay more for that.
And so that's kind of like, correct me if I'm wrong, but with that first property that you bought, that's exactly what you did. You added a little bit of value with hammer and nail, but then more importantly, you were adding value with pen and paper.
Yep, absolutely. On 38 Richard Pearce, had an opportunity to renegotiate the front lease. So there's a tenant at the front, so we're able to renegotiate that lease. So much longer term, slight rental increase, which again, that's immediate upside in terms of rental. And then the rear tenant at the back, they were massively under rented. So we knew over time we're going to be able to get that rent that they're paying up to market level, which again adds more cash flow, but also in turn, as Carl just mentioned, it reflects in the valuation as well.
So the initial value add was we had to get a CCC for the front part of the building.
Right. So that's code compliance,
Yep. And then we rewrote the lease for the front tenant, so a much longer lease. So that was value add stage one.
Yeah.
And then Jack was talking about the rear tenant. They were on a historical lease, which at that time was CPI indexed. So at that time, inflation had been low for a long time. So their market, their rent had never caught up with the market, and it was just massively under rented.
Actually, let me pause you there because that's a really important one.
Yeah.
So CPI indexation is sometimes, like, it makes sense, right? Intuitively.
Yes.
Let's make sure that the rent increases at the rate which is consistent with the loss of our purchasing power in the currency, right? Yeah. That makes sense, but this is just further testament to the fact that CPI should be relabeled CPLI sometimes, right? And the market proves this time and time again, because when it comes to the rent that you pay in these commercial buildings, sometimes it's not market rent, right? It falls behind over time. So what is it just a matter of taking the wording out of the lease where it says CPI indexed to market rate indexed?
So Jack will talk about the lease, but they were pretty much locked into just a CPI. And the ideal commercial lease is to have a mixture of CPI and market reviews. Sure. So Jack's an expert in that area, getting everything into the lease that we want. But you're going to talk about early settler?
Yeah, definitely. Yeah. So the example Carl just touched on with the ideal lease is to have a CPI plus 1% or 1.5 or even 2.5%.
Right.
So then you've got your CPI plus 2.5%. And ideally you can try and get that in annually. So every year the rent is increasing by CPI plus 1 or 2% or 2.5. So that's strong. Then what we like to do is we like to have market at least every 2, maybe every 3 years. We can live with every 3 years. Every 2 years is great. So that means you've got CPI plus 2% or market, whichever is the greater.
I see.
And you can write those into the leases. So that's a really strong lease because then as a landlord, this is looking at the landlord side, you're protected because you've got that.
It's ratcheting up.
Exactly. And as a tenant, you know what the increase is from day one. So to budget for it as a business. So for looking at it from the tenant's perspective. And in the case of 38 Richard Pearce, so we had early settler out the back. Great tenant covenant when we bought the building. The only issue was the lease was CPI indexed.
Yeah, and we saw that as icing on the cake quite a long time in the future. I think it was 4 years until their lease expired.
Yep.
But they called us within 1 year or 2 years.
So they had the market renewal coming up.
Yeah.
So that was probably about 6 months or 8 months after we purchased the building essentially. And they got us into their office, which is fine. And they said, guys, we don't want to renew the lease. And we're trying not to smile because that was the opportunity to get a new tenant. We're in a really strong area, so the fundamentals of this property, and get that rent up to market. So it worked out perfectly. So they left on that renewal, but we were able to get a new tenant. We actually had lots of tenants fighting for the space, which was great. And so we were actually able to get a new tenant at a much higher rent per square metre. So just to give you an indication back then, the rent they were paying per square metre was essentially $85 a square metre. And back then, this was beginning of 2018, the market rents were sitting around $135 per square metre. So that's a huge increase in rent for that
is
back.
Massive.
Yeah.
And you have to be quite quite market aware.
Yeah.
But it's also, to me, it kind of sounds like it's almost like a game of chess, right? Where you're anticipating what their next moves might be and what the market moves might be and all that sort of stuff as well, thrown in the mix.
Absolutely.
And so would you say, though, that creates the majority of the rise in valuation, or is that kind of just like a little bit of an enhancer?
Well, over the time that we've owned the property, we've had some market increases as well. So we had kind of both going, and we've also, since that tenant change in the rear warehouse, we've since then we've had another tenant change there, and also at the front tenant. So both those times there was big increases in rent as well. And Jack will tell you about the front tenant.
Yeah, so that was another opportunity. So that was the back of COVID. So, it was a gym. It was a gym. So we sorted out the CCC, got a certificate of public use. This is when we're buying the property. So before we bought it, we had a certificate of public use, which means the business can keep trading whilst we sorted the CCC.
Sure.
So we've got the CCC in place. It's all good. COVID comes along. Gyms got really hurt. So on the back of COVID, that gym really struggled, unfortunately. But what we're able to do, they had really good clientele, is Flex Fitness. Shout out to Flex Fitness. They're our new tenant there. They've taken over the building. We negotiated a really strong lease. So this is now to current times. We've got a really strong lease to Flex Fitness, and we've spent Flex Fitness spent nearly north of $800,000 on the building. From the fund's contribution, we did contribute probably at least $200,000 to $300,000. As well to the fit out, but it's a really strong fit out, and it's a really strong lease now. 8 years plus 8 years, so 8 plus 8. So it's a really strong lease and a huge rental increase based on what the previous tenant was paying. So that all that translates to, yes, there was a lot of capital outlaid in addition, but that return on that additional capital and that property has really increased the value of the property and the value of the cash flow.
Cool.
And out in the back warehouse, we had a scaffolding business. Same thing happened around sort of COVID. They didn't do very well, in the end had to move out. Almost within the next day, Jack had lined up another tenant, Renai New Zealand. Yeah. So now we've got two really, really strong corporate tenants in both parts of the building.
This is the same building that we're talking about,
Yes.
the first property that you bought
first
in this
property.
fund. Right.
So having good quality corporate tenants also adds value, because an investor coming in will pay more if they can see a good name, a corporate tenant. So that also has a bearing on the value.
Okay.
It lowers the cap rate, which Carl talked about before. So look, and this is the difference again between commercial, residential. Commercial, you're always working with cap rates. The valuers are looking at the cap rate, so that takes
the capitalization rate.
Yeah, and that takes into account the risk of the property, and having two corporate tenants, like Carl mentioned, that lowers that cap rate, makes it more attractive to other investors, which the valuers are going to put a lower cap rate on. So in turn, higher value. So
Got it.
Great.
Obviously, natural rent increases because of the market, more demand, but also you're adding value through really proactive renegotiations.
Yep.
And then that creates more equity in the fund, right?
Exactly.
More equity in that property, let's say.
Yeah.
And then what happened? So you were able to go to the bank, borrow a little bit more, because I think you guys borrow 30 to 40%.
45%. So
45%.
our lending covenant is 45. I think
Sure.
we're sitting right now today about 43%.
Okay.
So we float around between 40 and 45
Okay.
for the fund.
And so the next property, so this is in the first fund, was it more or less the same sort of idea that you try to buy it under market value, you improve the lease?
Definitely. So we always look at, we look at the area. That's number one, is the area. And then we look at what the medium term to long term upside in the property is. That's whether can we renegotiate a new lease whilst we're doing the due diligence, or is there upside in that property over time, like there was on Richard Pearce, the first property we bought. So it's looking for how can we add value, both value and cash flow, over the duration of that property.
Yeah. So the second property had a major structural issue, or perceived major structural issue. So again, it sat on the market for a long time, and we had a look at it and got our engineer involved, and the problem wasn't that bad in the end.
Oh, it was an easy solution.
It was quite an easy solution. So, but we kept that very, very quiet when we were negotiating
Right.
the price.
And so obviously the past performance isn't a promise of future performance, but what can you tell me about the performance of this fund? And maybe even like how many properties, how many tenants, overall valuation, what kind of numbers can you throw at me, Carl?
Currently, we've got 14 properties now.
In this fund, yeah.
In the first fund, and 23 tenants, and total value of 112 million, rent roll of 6 million. So getting quite substantial, and we're starting to sort of get some of those benefits of being, a sizable fund especially through our banking and our cost of the debt, basically the mortgages.
That fund is now closed for new investors. So can you take me through the logic behind why you closed the fund?
Yeah. Well, I think we've reached that sort of critical size, and we can now, the fund, because of its size, can buy properties without raising more equity. So increasing in value, and the LVR creeps down. So that gives us leeway to buy properties without issuing more shares.
I see.
So the existing shareholders get the full benefit.
Got it.
Yeah, so
it's not scaling anymore. It's not like in growth. Well, it's not an acquisition. No, it is an acquisition mode still. You're not trying to get equity from individual investors anymore, because you have enough of an engine which is creating its own equity, which will allow you to organically acquire properties. That with it. So capital gains plus a little bit more debt, you'll go out and keep on building it. The share price for the original investors, I guess that goes up because you're not diluting in any way, are you, by bringing on board any more shareholders?
Yeah.
That's pretty cool.
Yeah. So, and within the portfolio, there's still huge amounts of value to be added. I think we're at 8% under rented.
Yeah, and right? that's according to the valuers. That's not us, picking numbers. As at 31 March of this year, the portfolio is 8% under rented.
And some of the sites are really good land banks. So they've got a sitting tenant with a small amount of building in relation to the land. So there's opportunities there. And we thought, well, let's maximise the existing portfolio. If a good property comes along and it adding that property increases the cents per share for investors, and also the overall value of the fund, that makes sense.
Sure. Yep. So if people wanted to invest in this first fund still, they would have to wait until an existing shareholder wanted to exit, right?
Yes.
Okay. And I guess that's one of the potential drawbacks of an unlisted fund, is that you don't have the liquidity and the market pricing, which is instant, like what you would on the NZX, for example,
Correct.
right?
Yeah.
Okay. But is there a certain amount of shareholders that are always buying in and out? Is there quite a lot of movement there?
Not really. Most of our investors are there for the long term, and we like to say that it's an investment in property. And if you're investing in your own property, you want to go through a few property cycles to get the real benefits of the increased rent and also the increase of value over time.
Sure. Obviously, again, I'm going to stress it again. We can't say that this is a promise or a guarantee that the future performance will be the same, but what has been the performance of this fund?
I guess we can talk about it from the point of view of the foundation investors. So they came in at $1. And we did an analysis a little while ago, and we worked out, well, their dollar has become $1.56 over 8 years, and they've enjoyed an average of about 5.7 cash return.
Right, so the cash return plus the gains in their share price over that 8 year is your combined total return.
Yeah, so say 6% on average, and about 6% on average in terms of capital gain, so a total of 12%.
Yeah.
So that's our foundation investors. There have been investors that have come in at different prices and at different parts of the fund.
So the dynamics from here, though, are a bit different, because it's not like, again, going back to what you were saying before, because from here, it might depend a little bit. It'll always depend on your ability to extract more value from the existing portfolio of properties by creating value add and adjusting the lease terms. But if the market takes off again in the future, which it will, then now you have more equity and then it starts to scale, and then their share price might get more of an uplift, right?
Yep.
Definitely.
Yeah, so every year there's a valuation of all the properties, and we basically calculate the NTA share value.
What does that mean, NTA?
So it's the net tangible assets.
Right.
So we value all the properties, we take off all the liabilities, which is basically the debt and any other liabilities, and you're left with the equity. So that's what the shareholders own, and you divide the equity by the number of shareholders, and you come up with your
Share price.
or net tangible asset share price.
There we go.
Yep.
Nice. Okay. I'm learning a lot. This is good. So that fund is closed, but it's not over. It's not over, right? So let's talk about fund number 2. You guys are really cleverly, I like how you name your funds. Yep. So fund number 2, tell me about the
department.
Yeah, the marketing. Who's responsible? Right? So tell us a little bit about the foundation property for this fund.
So this is for Provincia 2. So great fund name.
Okay.
So the foundation property, we've got the one property in there now. So that's another really good property. So this is a property we've got down in Christchurch. So out of Auckland, but Christchurch, really strong location as well in the suburb of Hornby. So that's another really good industrial location in Christchurch. Mm-hmm. So this property is great. It was a sale and leaseback. So it's a sale and leaseback. So that's when the vendors, they own the property, who are now the tenants, they sold the property to free up capital or equity so they can reinvest in the business, and we bought the property. So doing that, we were able to do it direct with them. They're actually one of our existing tenants of Fund 1. So we know them quite well. They've got their North Island, their Auckland depot is in Fund number 1, and this is their South Island depot in Fund 2. So we've got that existing relationship with them, which is great. We know how the tenant operates. We know the tenant covenant very well, and so it was doing a lot of due diligence on the site, which it's a really really good location. Quite a big land bank, as Carl mentioned, that we have some in. Fund 1, this is another good land bank, so it's 7,500 square metre site, which is quite decent. And the lease that we're able to negotiate was a triple net lease, so sale and lease back and triple net.
Zoom in a little bit more on the triple net in terms of the expenses that are covered. So we're talking about rates.
Yep.
Body corporate fees, if applicable, but
not in this case. But management fees, if there were any, not in this case. But but it's also the triple net nature takes it a step further. So they're your OPEX, your insurance, your rates, your management fees. That's your outgoings. That's your OPEX. Take it a step further. They also pay the CapEx, so any capital expenditure. So roof replacements, drainage replacements, anything that normally a landlord would be responsible for outside of outgoings, the triple net covers that as well. So in this case,
my understanding previously is that the commercial landlord is the envelope, and everything inside, but a triple net goes further and it's covering capital expenses as well.
Exactly, and and so that's the strongest lease you can get. But it also gives the tenant more control over the site. They control the site.
A little bit of a trade-off.
Yeah, exactly.
Most commercial leases, the tenant will pay the rent and the normal operating expenses, so that's probably a double net. But a triple net, they pay what the landlord would normally pay as well, and like you said, that's the envelope or the outside of the building. So really, it's just a kind of a set and forget, isn't it?
And touching on those rent reviews as well, we were able to get annual rental increases. So we've got annual rental increases of 2.5%. So no CPI, it's just straight rental increases every single year. Ticks up 2.5 every year. But we get market every 3 years as well, or 2.5, whichever is the greater. So again, it's a really strong lease to set that fund number 2 up, and a good tenant covenant.
And would that triple net be more likely to be accepted by a tenant if the building itself was new?
Yes, definitely, because it's new build, limited.
Yeah, so I could just imagine if I was an engineering business and my building was just crumbling apart. There's no way I want to sign a lease like that, but. Maybe there is a case if their cash flow is sufficient that they can cover that.
It's true.
It's triple nets are more common with sale and leasebacks.
Sure,
because we get to basically write the lease, and because the tenant they're kind of used to being the owner of the building, they like to just carry on, and it's it's the same for them, but they get a big lot of equity out, which they can invest in their business, and they buy more trucks and invest in machinery.
I can also kind of see that applying really well in the case of, say, like a deceased estate. If there was a business that owned the building and they wanted to release a bit of the equity from the assets held within the estate, they could potentially do a sale and lease back, couldn't they?
Correct, yeah.
Keep the business operating for a while.
Yep.
There's maybe a bit of a dividend, a bit of passive income, but they've got their initial distribution.
Yes.
So that sounds quite interesting, especially if you didn't want to sell the business and the building in this current market.
Yeah.
You just want to sell the building in this current market for whatever reason, but there is still value in holding that business. So there's a lot of nuance here, isn't there?
Yep. Yeah. And we see a lot that's quite common in the industry right now. The sale and lease back, as Carl mentioned, freeing up equity to fund the business.
And what is the strategy with fund number 2? Is it more or less identical to the first fund in that you will be like adding value where possible, you'll be inserting more favorable terms into the lease, and really the market just does the rest, right?
Yeah, so exactly the same strategy. Stick with industrial, value add, and make sure we're in those good areas and multi-use type properties.
Okay.
So if something happens to the tenant, we can always find another one quite quickly.
Now, we might have touched on this last time, but just as a reminder, if nothing else, the reason why you target industrial commercial versus office and retail, what's the rationale there?
Well, the main reason is they're straightforward buildings, normally just a shed with a concrete floor and a couple of roller doors. With offices, if you've got tenants moving in and out, you're constantly refitting. You've got air conditioning, you've got lifts, big outgoings.
Yeah.
And also a lot of people working from home
Right.
at the moment, so there's lots of vacancies in the office area. Yeah. And the same goes with retail, even bulk retail. People are going, I don't want to sit in traffic, I'll just buy it online. That creates demand for warehousing. So that's what we're seeing. So a lot of people are doing basically buying online, so it comes straight from the warehouse, bypasses the retailer. So that's what we're seeing with
Right.
industrial.
And this is actually a transition from how business is being done, where technology has transformed commerce to the point now where, you're going to be ordering online. That's where your office will probably be all powered by AI agents, in no time. So do you see like the retail and the office sectors as being almost undervalued yet? Or do you think those sectors they still have a ways to go before they kind of normalize?
We've looked at what some of the other funds are doing, who have the sort of retail and office mix, and they both those sectors suffered big vacancies, especially over the COVID period, and we managed to maintain almost 100% occupancy from when we started the fund.
Okay.
So as I probably said before, Jack gets himself in trouble because he doesn't like to tarnish his record of 100% occupancy. So he has tenants moving in and out on the same day, which is not always good for logistics.
I bet. I can imagine.
No way.
And I guess if you set things up really well from the start, you often have better experiences anyway, right? So if your lease terms at the beginning, if your due diligence is done like rock solid at the start, you're set up for success like long term. So can one of you speak to your infamous 38-point due diligence checklist that you use when you're kind of trying to zone in on a property?
Yeah, so that's our checklist that we use. So it's 38 points. So we really rip the property to shreds. The tenant, everything to do with that property. There's 38 points of checks that we do on that list. Number of items such as the earthquake rating, geotech, the lease. They're the standard ones, but there's 38 items we go through. So we go through very detailed to make sure we're not missing something on that property or on that lease or on that tenant covenant.
And in your opinion, do you feel like a lot of commercial property investors who go it alone, who buy the commercial property themselves directly, do you feel like the level of due diligence generally is good enough, or do you feel like that's one of your competitive advantages? I know it's a bit of a leading question.
It's a list that we've built up over a number of years,
Right.
just through personal experience. And some of the real estate agents really hate us.
Because you're potentially wasting their time, right?
No, because we're very thorough.
Right.
And one of the last properties we bought, the vendor said to us, "Jeepers, I really felt like I was going through an audit with you guys."
That's good.
So we don't miss anything. for example, we fly a drone over the property, have a really good look at the roof, guttering, and then get advice from our plumber. So if there's any sort of maintenance in the future, we know we can budget for it. Or what quite often happens is we can see a problem and we can use that as negotiation on the purchase price.
Okay. I can see how your 38-point checklist is probably quite instrumental in creating these good outcomes. I know myself as a residential property investor, I'd probably have more of an informal checklist that I'd tick off the list. But with commercial, if you don't know what you're doing, it's kind of dangerous, right? So tell me a little bit more about the private client service now and the linkage between the due diligence that you put these vendors through and how you can share that with others, basically.
Yeah, so one part of our business is the fund, running the funds, and the other part is private client. So that's direct ownership. So some people prefer to own properties directly. They don't like the idea of investing with others. So that's for that group of people. And some of our clients invest in both. So they invest in our fund and also our private client service.
Right. So it's kind of like almost like a core satellite approach. That they have diversified portfolio of commercial properties and then one specific holding that they have.
Yes.
Or more.
Yeah, one or two or three or whatever.
Yeah.
So typically a private client will come to us and say, we'd like to spend this much money, and we'll go out there with our team, Jack and his team, and find a property that suits them, and then we'll get it under contract and we'll do all the due diligence. So everything on the 38-point list, and we'll take our client through the property, make sure that they're fully comfortable with it, and then if they are, we'll go unconditional. We control the whole process, right from sale and purchase,
right,
due diligence, and finishing off in the end doing all the legal checks.
Who finds the property in this situation again?
Jack and his team, and they've got a list of agents that they work with, and also we quite often get properties that are not quite on the market.
Got it.
So that's what we call off market.
Yeah. And how often do people come up to you with the property that they've seen?
Quite a lot as well. That's the other one was with vendors. Vendors approach us as well, or vendors that are looking at selling their property. They know us in the market. Well, we're not agents. We're not brokers, but vendors do know us in property, and vendors do know that we have clients looking to purchase.
Got it. So you might occasionally make an introduction,
absolutely,
but that's not representing the property and representing the vendor.
Not at all. We represent the private client. If we're doing the private client service, we're representing the private client side.
And what's the revenue model with that? How do you guys get paid for that type of service?
So it's just a set fee. It's a percentage fee, but it's only payable should the client go unconditional. So they sign up to work with us. There's obviously a contract to sign. No obligations there, but it's a contract. When we work with them, we want to understand their strategy, what they're trying to achieve out of property, and what their risk profile is, and what they want to get out of it. So once we ascertain that, then we can put it together. Okay, this should be the strategy this client wants to work with. And we have a list of properties.
And that risk profile is really important.
Yeah.
So we sit down and interview, have a really good chat with our client. One of our clients has got all cash, and he's happy to buy something that's vacant and add a bit of value. He's not having to pay a mortgage or anything. So he's kind of the more savvy investor. And then we've got other investors that they're leveraging a bit. So they want a longer-term lease and a sitting tenant, and maybe we can add sort of some value through the lease on that property for them.
Okay. And so just give me an example then of how you've worked with a private client. I'm specifically curious about this off-market thing because I know what it's like to potentially sell a property, and it can be pretty full on. In the residential space, I imagine commercially it would be the same.
Yes.
And the first person they're probably going to talk to would be people they already know.
Exactly.
So I can understand that you would come across a lot of those opportunities, but how does that work?
Yeah, so with that, the agents approach us because they know we have certain clients we're working with. So one example, we had a client, he owns a business, a really good business. He's Christchurch based, really good investor, but he wanted to diversify his portfolio and move into commercial property. And he hasn't done this before with commercial. So that's why he came and talked to us. So it's diversifying that business, and he knows we can help him get into commercial and make sure we're doing the due diligence, make sure he hasn't made a mistake or mistakes.
So very successful businessman, quite invested in residential. His next step is commercial. Yeah, so we're assisting him to build his commercial portfolio.
So he's approached us. We've got the client ready to go. The agents always know we've got clients there, so they approach us direct with off-market opportunities. So they're ones the properties that they've got on the market that it's not on the market, it's not listed online. So
Okay, and just touching on that ideal client, concept. You mentioned somebody who is quite successful in business, or they have a large residential property that they're keen to add some diversification into. Is that the ideal client? Like somebody who's kind of grown out of residential, for example?
Yeah, so we get a range of people. So some who have sold their business. So had a business for 20 or 30 years, used to very, very good cash flow, and suddenly no cash flow.
Right.
So in that case, we found a property to replace that client's income from his business. He was a bit worried about eating into his capital. So that was the purpose for that client. We've also got one that we're looking for at the moment for an owner-occupier. So he's got a successful business. He's sick of paying rent. So he wants to buy something that his business can grow into, and possibly he could have a subtenant next door as well.
Got it. So that's quite a specific request from a business person who's saying, but that's cool. But that's kind of, so you know about that now. And then if an agent approaches you, you kind of, so there is a bit of a matching going on, but it's more of a networking thing that's going on rather than a real estate agency type thing, because you're charging the purchaser, not the vendor.
Correct. Yep.
So really there's a real estate agent that's clipping the ticket potentially in some sort of, off-market way, however they work.
Yep.
And then you'll be collecting a fee because of the work that you're doing, not because you are gatekeeping access to a property, but because you're helping people to perform due diligence, which is what they need to do anyway.
And we like to think, as part of the due diligence checklist as well, we like to think that we add a lot of value in that as well.
Yeah.
So we can quite often change the lease during that due diligence period to add a huge amount of value.
Yes. Okay.
Before the unconditional date.
Okay.
Yeah.
Now, I'm curious, do you receive a lot of inquiry from overseas?
Yeah,
We've got a few clients actually.
We talked to some people in Singapore.
No, there's a few
recently.
We've got a few,
but not a lot.
Yeah,
Right.
Yeah.
Yeah, because one of the things that I've been watching lately with interest is in Australia, the superannuation schemes, the self-managed super schemes.
Yes. Yeah.
Sometimes they'll be commercial property investors.
Yes.
And if they are liquidating because they are able to for a start, and they're worried about whatever, they might look at New Zealand as an opportunity, and they might think, well, how do I get access to this market? I understand commercial property. I just don't understand the New Zealand context. And to me, it kind of sounds like, well, what you're talking about is perfect, right?
It is perfect. That's exactly what we're there for, to work through that.
Got it. But a little bit from Singapore, maybe eventually a lot more from Australia.
Potentially.
Who knows? But most of your investors are Kiwis, New Zealanders?
Correct.
Yeah.
Yeah.
Okay.
And a lot of them are, mum and dad type investors wanting to diversify, as Carl touched on, diversify out of their residential portfolio.
Yes.
That's a lot of the clients we're working with as well, actually.
Okay. So again, you already mentioned the ideal investor. Can you just remind us the relevance of the wholesale investor thing? Because I guess if you were using the private client service and you're just using you to buy a property, well, anyone can do that.
Yes.
Yeah.
But in terms of the unlisted fund, just remind us why that's relevant, that word.
Yeah, so wholesale is meant to be a sophisticated investor, so someone who's had experience in investing themselves. And there's quite a long list of ways they can qualify. And what happens when, as part of our application for the fund, they have to fill out a questionnaire. They have to get a certificate from their financial advisor.
Done a few of those. Yeah.
So it's
Not with you guys though.
Wholesale
I have done a few
investor
of those.
certificate.
Yep.
But some investors just qualify automatically, so they don't have to get a certificate from their financial advisor because they're very experienced. So there's quite a long list of how you can qualify. And the difference between wholesale and retail is that with wholesale, you don't have to disclose and explain every little detail. So it's assumed that the person has enough experience to understand it. Whereas in retail, you have to have a product disclosure statement. So that's a very, very big detailed document.
Yeah. And that creates a bit of drag, right? Expense, which means the net return will be lower, but you're being disclosed more. We can't say that it makes it safer, because there's no such thing as really a safe investment in really anything, to be honest, right? But it's about having more information to make a decision from. And I guess if it was a retail offering, it's a more of a prescriptive template for that disclosure.
Yeah, and the entry price is lower as well with retail.
Sure.
So
that's right.
Typically chunks of 10 grand or 5 grand.
Right.
With wholesale, we're 50,000 minimum for our fund.
Sure.
So it says that if you've got 50 to invest and you pass the wholesale investor criteria, you can invest.
That's good.
We still have to have an investment statement. It's just not to the degree of a product disclosure statement. So there's still an investment statement that they've got to read and understand, and that sets out the terms.
Right. So I know there'll be people listening and watching who will be kind of thinking, hey, is this an appropriate way for me to gain exposure to commercial property in New Zealand? And if they are asking themselves that question, what would be a really practical step or steps for them to take for the commercial property funds and or the private client service?
Yeah, I guess if they're interested in the fund, we've got an investment statement. So we've got it on our website, Provincia, www.provincia.co.nz, and there's a investment statement download. So that's probably the easy way to grab the investment statement, or reach out to me or Carl or one of the team. And that's the investment statement for the fund, so for Fund 2, which is now open and raising. And the other option would be the private client. So if that's something that people are interested in, I think the best way would be to have a chat with me or Carl, contact us, email or phone. Yeah. And have a no obligation chat.
Have a look on our website under private client. Generally, it's a big investment for someone, so we always like to meet in person.
Yes.
So we're happy to drive around the country, jump on a plane. Typically, we would go and see people and meet face to face, have lunch. Yeah. And
who's buying?
Really explain it.
Normally him.
Good. Yeah, that's good. And it's a massive decision, right? Like investing any amount. Right?
Yeah. Absolutely. There's no obligation in any of this. Yeah. So it's just to make sure it's right for them.
Yeah,
if it fits right.
And I guess like the other part of this is that you're always going to be accepting new investors anyway, right? But you will close off funds because it reaches its maturation point.
Yes.
And it's in the best interest of all the investors, right?
And timing as well. Like if there's a new raise, which we're currently working on right now, that's a good time to get in because we've got a property. We're not always going to have a property to raise for, even though it's an open-ended fund.
Yeah,
the intention is to keep raising, but...
Got it. Okay. So www.provincia.co.nz, that's where people can go to get that investor statement and to go further. Okay. That's awesome. Well, thank you very much, guys. Carl Burling, Jack Revill from Provincia Property Fund. Thank you.
Thank you.
Thank you. Cheers.